Okay, we've got one word for you right now to describe the markets. How's this? Shaky. Volatility, that's another word, and it's been creeping up. The S&P 500 has closed up or down more than 1% 4 times in the past 10 days. That's the longest streak, by the way, in over a month. And one place to seek returns in a more uncertain market, how about high dividend yielding stocks? And there are option strategies for how to play them. So let's get to two sides of the dividend play. We've got Larry Shover, the Chief Investment Officer at SFG Alternatives. He joins us from the CME in Chicago. And on the other side, we've also got Marty Sass right here, legendary investor, sticking around with us. He's with us all hour. All right, Larry Shover, why don't we go with you first? Very volatile, good for a trader like you. How are you using that to your advantage in options right now?
Well, right now I'm looking at what's cheap, and people do like dividend plays, so I'm looking at more like XLU, which has really cheap 3-month volatility right now, like 13.7. With that said, I think it's a great time to be buying like 1x2 call spreads if you're like me and constructively bullish in that sector. Right now in September, you can buy like the 39.41 1x2 call spread for about 20 cents, so it gives you a lot of upside potential, spending 20 cents to perhaps make $2.
All right, this is curious. So you're going to utilities in the first place because utilities obviously pay high dividends. 4.2% right now is the average for utilities. The XLU pays a dividend, but rather than buy the XLU, you're doing it with a call spread. You're basically long a 39.40 call spread, and then you're selling an extra call against it. Is that right?
Yeah, actually, it's a 39.41 call spread. So, yeah, you're buying one, selling two. You're going to need a 13.5% rally in XLU before you start losing money on the trade. So it's a good risk-reward given skew in XLU is so cheap. Right now, it's like a 33rd percentile as judged over the last year. So good time to get long 1x2 vertical spreads.
Marty Sass, I'm curious to get your take on that because you tend to do this more with stocks and options together. Here's a pure options play. What do you make of that?
Yeah, well, actually, I have a different approach, and there's a lot of ways to play options, as you know. So mine is a portfolio manager's approach as a portion of a portfolio where you mentioned at the outset of this segment that we have high volatility in the markets, and that's quite right. And the investors are afraid of this volatility. One way that they can dampen it is to buy high-quality stocks yielding more than the market. Our portfolio, which we call Equity Income Plus, generates a 3% dividend yield, and then sell out of the money call options against the position. So typically, say 10% out of the money. That gives you 10% upside to the strike price. Meanwhile, you're collecting option premium income in addition to the dividend. If you put the two together, which we do, you can generate an 8.5% cash flow just from dividends plus option premium income today. 10% out of the money, 8.5% a year cash flow. So if the market is flat and the stocks are flat, you generate 8.5%. If the market goes down, you have downside protection from the dividends and the option premiums. You're giving up some,
again, about 8%.
Yeah, that's right.
So that works. Hey, you know, I'm curious, Larry Shover, to get your take, because if you're long a call spread, you have upside, but you don't get the dividend. You'd have to exercise your
complimentary 2-week sample of